Now let's move to the second problem. Same page number 12.52. You can pause the video and read the question. Okay, so we will see what is given in the problem. Sky Slope had planned, when it originally designed its budget, to buy its artificial ice for rupees 10 per kg. However, due to subsequent innovations in technology, producers slashed their prices to rupees 9.70 per kg, and this figure is now considered to be a general market price for the purpose of performance assessment for the budget period. Okay, so what happened was, Sky Slope is a company or is an entity, and it has prepared its original budget to buy artificial ice, and it has budgeted the cost of artificial ice at rupees 10 per kg. But subsequently, what happened, there was a lot of changes in the technology, and due to that changes in the technology, the price of artificial ices went down to 9.70 per kg. So there is reduction in the material cost from 10 rupee to 9.70, and this 9.70 per kg is considered to be the new standard for the purpose of performance assessment of the for the budget period. Now the entity paid, actual price paid was rupees 9.50, as the Sky Slope procurement department negotiated strongly for a better price. The other information relating to that period is given. The original standard, ex ante, revised standard, that is given, and actual units is given. You are required to calculate the variances for ice by traditional variance method, and also an approach which distinguishes between the planning and operational variances, and also interpret the result. Okay, so we will it's a very direct question. We have done similar problem when we discussed that particular portion, that is operational planning variance. Now we will straight away move to the variances. Okay, so first is traditional variance. Traditional variance. Basically, since it is a material, you may have usage variance as well as price variance. So first we will take usage variance. How do you compute the usage variance? What was the original planned production? It was 5,500, revised also 5,500, and actual also 5,500. So there is no change in the production plans. Budgeted 5,500, actually it was actual production was also 5,500. Okay, so as per the budget, what was the requirement for the material requirement? It was 5,500 into 5, that is 27,500. But actually how many we consumed? 27 to 25. Okay, so usage variance, standard quantity for actual production minus actual quantity into standard price. Okay, so that is equal to, what is SQ? SQ is 5,500 into 5. Minus, what is AQ? AQ is 27 to 25. And what is SP? SP is rupees 10. Okay, so that will be 27,500 minus 27,500 minus 27 to 25. 27 to 25 into 10. So you planned for 27,500, but how much you consumed? 27 to 25 only. So is it a favorable variance or unfavorable variance? It is a favorable variance. So it comes to 275 into 10. So 2750 rupees. This is favorable. Okay, now next is price variance. What was the original price? The formula is SP minus AP into AQ. Am I right? Okay, what is SP? SP was 10 original price, and the actual price was 9.50. So rupees 10 minus rupees 9.50 into actual quantity is 27 to 25 kgs, and that will give you the price has come down. So again it is a favorable variance, and this will be rupees 13,612.50, again favorable. So total material cost variance is equal to how much? 2750 favorable plus 13,612.50 favorable, and the total will be rupees 16,362.50 favorable. Okay, now what you have to do, you need to have operational variance and planning variance. Okay, so first we will do the planning variance, right? Then we will go to operational variance. Planning variance is the variance between first budget and the revised budget, original budget and revised budget. Original budget versus revised budget. Okay, start with usage variance. Usage variance, how much? Original it was 5,500 into 5, then 5,500 into 4.75. okay, so 5,500 into 5 minus 5,500 into 4.5 into what? Into SP. What is SP? 10. Okay, so that is equal to 27,500 minus 26,125 into 10. And what happened to the material consumption? It has reduced from 27,500 to 26,125 when the revised budget was prepared. So it is 13,750 favorable. Now price variance. What's happening with price variance? Original rate is rupees 10 minus what is the selling price in the revised this one? It is 9.70. 9.70 into 26,125. That is equal to 0.3 into 26,125. That will be 7837.50. 7837.50. Again it is favorable because cost is coming down. So total variance will be 13,750 favorable plus 7837.50 favorable, and total will be 13,750 plus 7837.5, that is equal to 21,587.50 favorable. Okay, now that is planning. Now operational variance. Operational variance, how do you compute? First is usage variance. It is revised budget versus actual. Revised budget SPE. What was the quantity, standard quantity as per revised budget? It was 26,125. Okay, so 26,125 minus what is actual? Actual is 27,225. 27,225 into what is the cost? Actual cost is 9.70. Standard cost is 9.70 rupees. 9.70. That will give you 26,125. 26,125 minus 27,225 into 9.7 will be 10,670 adverse. Rupees 10,670 adverse. That is usage variance. Now you will have what? Price variance. Price variance 9.70 was the standard rate and the actual rate was how much? 9.50. 9.50. This is rupees, this is rupees. On actual quantity was 27,225 kg. That will give you 0.2 into 27,225, 5,445. The price reduced from 9.70 standard rate to actual rate is only 9.50. So it is favorable. Okay. So total cost variance is equal to rupees 10,670 adverse plus rupees 5,445 favorable. It is equal to 5,225 adverse net. Okay, so that is operational variance. Now I think interpretation of result is left. Okay, so you can write okay, you can write traditional variance, planning variance and operational variance. Okay, here usage variance, price variance. Okay, traditional variance, what is usage variance? 2750 favorable. Price variance how much? 13,61250 favorable. Total comes to 16,362.50 favorable. Okay, now planning variance, usage variance how much? Usage variance is 13,750 favorable. Price variance is 7,837.50 favorable. Net will be 21,587.50 favorable. Okay, now what about operational variance? Operational variance usage is 10,670. Okay, then 5,445. Okay, total is what? 5,225 adverse. Okay, now what is the analysis you can do? If you are using traditional variance alone, what would be the analysis you can make? You will say that in both usage terms and price variance, the company price variance, the entity is favorable. That means the company is doing exceptionally well in terms of material consumption, both in terms of price negotiation as well as the consumption part. That would be the inference if you are using traditional variance only. But when you do the analysis based on planning variance and operational variance, there is something striking. With respect to price variance, it is favorable on both planning component as well as operational component. Okay, there is no issue. So the company is effective and efficient with respect to price negotiation. But when it comes to the usage or consumption variance, the total consumption variance or usage variance of 2750 is on account of planning variance as well as operational variance. In terms of planning variance, you have a favorable position with to the extent of 13,750, but from the operational part, you have an adverse variance. That means your raw material consumption is not as efficient as it ought to be, and it has resulted in an adverse variance of 10,670, due to which the net impact or the net effect of favorable planning variance was not reflected in the the profit of the company. Okay, so you can write, if the variance is analyzed based on traditional variance alone, it may be inferred that the company, I am calling it as a company, I don't know whether it is a company or partnership, whatever, it is not given, but the company is it may be inferred that the company is efficient both in terms of price negotiation and material consumption. How do you come to such a conclusion? Because as both price variance and usage variances are favorable. Okay, this is the primary inference if you are using only traditional variance. However, when the analysis is done based on the planning and operational variances, the entity will be able to better analyze the impact of planning on the variance part and the impact of operations on the variance. Okay, it may be observed that the price variance is favorable under both planning and operational variance. However, what is the problem? However, the usage variance is not favorable for operational variances. Okay, operational variances. It means the variance, it means the inefficient consumption of materials has resulted in A in an adverse variance of rupees 10,670 on account of operational variances. Okay, so this is the inference you can make. Okay, so only when you analyze the traditional variance into planning and operational, you will come to know how much of your variance is due to planning errors or planning changes. Okay, and how much of your total variance is on account of operational inefficiencies or operational efficiencies. Okay, and these two things should be bifurcated, and these two things should be analyzed separately in order to avoid variances in future. Is it clear? Okay, right.